Good morning and welcome. On behalf of the MEF, you'll be joining us today on a conversation regarding the ripple effects of mergers and acquisitions in the CPaaS messaging aggregator and connectivity space. First, on behalf of the panel that will be joining us in a moment, let me thank the MEF for inviting us to discuss the dynamics of acquisitions and mergers in the mobile connectivity space. We hope to provide you with a compelling and captivating conversation today. Now, I'm going to dispense with the usual details of covering over individual biographies. Suffice to say, our panelists have close to a century of experience operating in the mobile services and connectivity business, either driving business or driving deals, or driving both. For the pride of our collective parents, however, for what it's worth, the panel possesses 4 graduate or undergraduate degrees from the Ivy League, an engineering master's degrees, and a PhD in economics, our ringer, an honest broker academic who holds the Philip Knight, who founded Nike, chair of social science at the University of Oregon. So, gentlemen, shake hands with our virtual audience. First, Lawrence Askowitz is the managing director of State Street Bank, a leading investment and acquisition advisor in our space. Hello, Lawrence.
Hi, it's actually Bank Street Group, but thank you. That's there is a State Street, but I don't work for State Street.
I'm sorry. I'm sorry.
Not at all. Bank Street's sort of generic sounding as well.
Indeed.
And I like that earlier picture where my beard wasn't as gray, so I like that.
Oh, okay. We aim to please, Lawrence. Dimitri Menetis is the managing director of Q Advisors, also a leading investment bank in the TMT space. Dimitri?
Thank you, Paul.
Hello. Alan Masaryk is the former CEO of Vonage, who put Vonage on the path to being a CPaaS before the term was coined. Morning, Alan.
Good morning. Good morning.
And Professor Bruce Blonigan, who has studied global business, M&A effects, and the dynamics of multinational firm investments over the course of his academic career. Hey, Bruce.
Hey, good morning. I usually wear t-shirts and jeans, and I thought I'm coming to a corporate panel, and I overdressed. Oh, my bad.
No worries. So, inverting the usual steps, first I want to thank the panelists for making yourself available to our audience and taking time to share your perspectives in these exciting and interesting times in the Interconnect segment. Note to the audience, the frame of this conversation isn't really a primer on M&A within the CPaaS segment, nor is it really a news listing on recent M&A activity. We covered that very effectively in our last discussion on behalf of the MEF, that was held in November and is available on the MEF website and also on YouTube if you'd like to watch it. Today, we'll address the ripple effects of acquisitions within the industry, essentially the terrain changes in a market as a result of moves by a company, either your own company or competitor, or even multiple competitors. What drives those moves, what considerations to weigh, and potentially what actions to take. Which leads me to an appropriate story to set the stage. Recently, the chairman of an international interconnect company unexpectedly passed away. And he's on his way to meet St. Peter. And against all odds, St. Peter points to a door that's marked heaven. Now, the chairman rubs his hands in glee, opens the door, but he sees flames and hears cries of anguish coming from the door. He quickly slams the door and he tells St. Peter, "Wait, you showed me the wrong way. That looks like hell. That's not heaven." St. Peter answers, "Oh, you didn't know? We merged this morning." So the moral here is that in acquisitions and mergers, you don't always know or have a guarantee of what may transpire. How your rivals could affect your own strategy, how acquisition can change conditions and drive new strategies. Both internal and external factors need to be considered. So let me start with Bruce to kick off our factor analysis, if you will. And then I'll toss the same question to the others, reflecting your perspective either as deal makers or deal drivers. What should industry leaders be thinking in this fast-paced acquisition flow we're all floating in right now? So Bruce, you have the floor.
Great. Well, this is an incredibly fascinating industry with mergers and acquisitions. And I just want to point out that, right now stock market valuations are high. Lots of companies have cash. That would suggest that, across the nation, we'd be seeing tons of mergers and acquisitions. It didn't happen last year. Surprise, surprise. The obvious thing is we had a pandemic. And, most industries were kind of sitting on the sidelines, and firms were piling up cash because they really want to see what's going to be happening. Where are we going? How do we come out of this pandemic? This industry has been very unusual in that because, things start moving so fast, and with people working remotely and being remote with anything that they're doing, leisure and professional, you can just see that this industry, you couldn't wait on the sidelines, right? And people have to take off. And so that to me has been really interesting in thinking about this industry. And the other part about this industry, I think, that is incredibly fascinating is I think there's multiple reasons for mergers and acquisitions to be going on in this industry. Sometimes it's just a story of consolidation or other things that starts leading mergers and acquisitions in a particular industry. This one has a number of things going on. First would be simply trying to build networks, trying to build customer base, market share, and trying to create a standard and perhaps hopefully dominant platform down the road, right? So that's one big part of it that's going on right now. But it's also, even saying that, it's about building networks, there's customer bases, but it's also about kind of trying to build your platform. And part of building a platform might be trying to make sure that you have as many bells and whistles and the new bells and whistles that are coming through. And so oftentimes companies face like, do we keep innovating ourselves? Or if we can't even keep up, do we need to go out and buy some solutions for ourselves quickly that we can't do in-house? And so both trying to scale up and building networks, but also looking to find important technologies, innovations, products that you can use for yourself. And then finally, actually, the prior interview, we were listening backstage a little bit, and it came up about adjacent players. And, CPaaS folks are in the middle of kind of a group of different types of firms. And some are pretty big, like mobile network operators, for instance, that are looking to this, and also even just large corporations that maybe just want to have something in-house. So adjacent players, big players in adjacent industries may also just want to be trying to get their own solutions or to actually start, taking over some networks. So that to me suggests a very interesting landscape. And I don't think that, something's going to happen where there's going to be consolidation here in the next couple of years by any stretch, because all those different dimensions going. And so I just want to set the stage that way. My role here is to give the 10,000 foot view, and then I'm going to try and get out of the way and let some of our practitioners talk a little bit more as they will about those motives.
Yes, thank you. So Lawrence, as a deal maker, what's your take on the current conditions within the segment?
I agree with Bruce. I agree with Silvio at the last panel. When you have stock market valuations that are high, that makes it attractive for people to pursue transactions. When private equity is looking for an angle to get into the market, and we've seen that at MessageBird, we saw it at Cinch with SoftBank, even though it's already a public company. One Equity in Infobip. I think there are others who are looking for a platform to go ahead and get involved in finding a good sized platform. So these businesses need to grow, and I think there's a fear factor in being left behind. So I agree that Bruce's comment of cash coming into the market and good stock market valuations is making people think about it. trying to find the right scale and right partners to go ahead and grow. I think you look at Cinch's stock market valuation. A lot of people look at Twilio stock market the last 2.5 years and how its valuations have really grown, and its stock price has allowed it to buy these other companies or invest in a company like Cineverse. I think people perhaps aren't paying attention to Cinch's market cap and how much has changed there and their ability to do a lot of M&A, not just for geographic reasons, but really the product mix as well. So those dynamics, and I think the desire to perhaps get into the U.S. is making people look at M&A, look for some U.S. connectivity, has been an important theme for people. Getting good logos has brought InfoBip to pursue open market, Cinch to pursue IntelliQuint. So there's been a lot of push, I think, for people to find some U.S. anchor also. So, but it goes to Bruce's point that there is still lofty valuations. I'm not saying that it's not deserving, but the stock markets have been very good in this sector. And there's money coming in and still continues to want to come in. So that will continue to feed the desire to continue to grow through M&A.
Indeed, indeed. Ancient Chinese curse, may you live in interesting times. Dimitri, what's your take as relative to your noble competitor's perspective and the factor analysis that goes into these things these days?
Yeah, no, I agree with both Lawrence, Bruce, well, kind of their view of the market and you know this specific CPaaS messaging and everything around that space world that we're living in. And so the interesting kind of perspective would be that to kind of look back and say, okay, if you split this industry into several buckets as it would relate to the M&A process, you know, you would have probably a software layer, then you would have a connectivity layer, then you would have certain geographies and adjacencies. And I think what we're seeing now is all four coming together in this land grab mode that's been accelerated in the pandemic through the digital interactions that are up tremendously. You know, there were several reports out there talking about how digital had moved during the pandemic and these interactions that people use over a digital interface are up. You know, at Twilio, for example, they had a report out at the start of the year talking about 50% plus of digital interaction increase during the pandemic. So that customer engagement, digital engagement is driving this tremendous consolidation across all these different layers, starting with just the pure software APIs, down to the connectivity layer, branching into various geographies, and then adding on all these specific adjacencies, be it in the, you know, CDP world, as the prior panel had talked about, you know, customer data and IoT, for example, in the mobile world, and security and identity management to make these interactions more personalized. And so it is the industry in the land grab mode, market share, geographic expansion, and then vertical integration across the board. And that's, I think, what we're seeing here.
Indeed, indeed. So, Alan, you're the deal driver, having been a CEO of a company that went off and pursued. You crafted the strategy and then pursued and executed on it excellently. What's your perspective?
So I think it's interesting where there. I don't want to repeat what the other folks said because I generally agree with it. I think that if you look at the market from two perspectives, there's two macro drivers. The private equity activity is consistent with just sort of a generic industry like we're in, which is a massive TAM, relatively early, where there is a great deal of opportunity for the PE world to buy and take public later, sort of harvest the, you know, the classic private to public arbitrage. And you see a ton of dough and a ton of activity. Now, interestingly, from the strategic side, I think there's two trends going on because the industry is still relatively early. but you see stock market valuations which are very high that give strategic currency in order to do deals. That may look more like a consolidation play that you might typically see later in cycle, but you have some, high valuation currency. And the other thing is exactly what Dimitri was just talking about, which is the notion of communications itself is almost a misnomer. The reason you're having all this consolidation is to develop really a customer experience platform as the world goes more digital. So the communications element of it is simply, how you provide customer engagement is in an omni-channel way, and the communication provider, it may start at its, kind of as a CPaaS kernel, which years ago was just SMS, and now it's expanded to the other modalities. But then it expands into other elements, and you see all the transactional activity up and down the stack, as Dimitri said. So, think of Twilio backward integrating most recently with Cineverse, or the open market acquisition moving back into the connectivity layer because SMS has traditionally low margins, or forward integrating, into other modalities like they did with SendGrid, or sort of just customer experience itself like they did with Segment. So that's the path that you're seeing, and whether it's what Cisco did with IMI, it's all the same trend that you're seeing, where you're moving from an element of communication or multiple elements of communication into more of an engagement platform. That's where it's going. And even if you look at the folks who came at from different areas, or different angles, like Salesforce from the CRM side, hell, that's what they're doing. In fact, I would maintain that even Teams and Microsoft is doing the exact same thing, because it's all as the world is sort of obviously more and more digital, and got there so much more quickly than folks thought, spurred by the pandemic. Now you see sort of everyone is sort of tacking after a similar strategy of this more holistic customer experience platform.
Indeed, and just in terms of news of the moment, I saw right before we started that Microsoft has put an offer up for $10 million to a company called Discord. And Discord is an interesting convergence between a games platform and a messaging platform. And if they've got that as an asset and a technology capability, no doubt they can easily extend it into traditional messaging, into the traditional CPaaS play. It's kind of either a side door entrance, but it speaks to exactly what you just laid out, Alan, in the context of, and Dimitri as well, in terms of the layers of opportunity and how it can be entered, whether you're in the space or adjacent to the space. So, there's an old Wall Street saying, if the music is playing, you got to dance. So if you're sitting here, either listening to us this morning pontificate and talk about this space, if you're a board member, an investor, an executive leadership team member of a company, what should you be thinking right now in terms of, if we go back to November, I was talking about back then, is this a bleak or chic industry? Meaning, are we going to be taking off, or because of the commoditization forces that we all have an understanding of, is this really just a false thing to pursue? Obviously, that's not the case, because we've got even more activity in the last 5 months than we would have ever expected. I think Nick Lane from Mobile Squared this morning or yesterday morning talked about that COVID activity has driven enterprise application to person messaging by 20% in the last year, far exceeding any other expectations and far exceeding any other industries that we also well know in terms of the COVID effects. So if you're in that situation, Alan, you also had great advice last time in terms of you got to decide whether you're going to be predator or bait. Well, we all know what's happened in the last 5 months. How can they refine? How can this executive class begin to refine their efforts, refine their strategies? What actions can they take to help themselves now?
I think it's within the notion of bleak or chic. I clearly think it's chic. But I'll go back to the commentary I did in November about you have to be really clear-headed as to whether you can realistically be the predator or are you bait. And being bait is perfectly fine, because I think sort of the threshold level of success is higher, because exactly what Dimitri was talking about before, which is the solution is pretty damn broad as you move more and more into an engagement platform. So if you're a component, if you do SMS well, programmable SMS or programmable, video, a single element of it, or, what have you, or you're a single element of engagement solution, you may have ambitions to sort of be the whole thing. About having, your eyeballs are bigger than your stomach, something like that. You better have the resources and the capacity to pull it off, because if you don't, it's perfectly fine in this world to be bait. I think you'll get paid handsomely for it because the valuations are way up. But I think it would be a mistake if I were a board member to sit back and say, let me rock and roll down a 5-year path and build the whole thing, because I'm going to be one of the huge successful winners at the end. That may be really tough if you don't have the team, the resources, the footprint, elements of the platform already in place, all those sorts of things. You need to be pretty realistic about it, is my advice.
Yeah,
Lawrence, go ahead, Dimitri.
go ahead, Lawrence.
I was just going to say, I completely agree with Alan. I've been a board member of 5 different companies, public and private, and assessing where you really are in your business is critical. Every business, no matter whether it's big or small, has got wonderful opportunities and perhaps some challenges as well. And if you're taking a look realistically that it's time to exit, we're too much of a minnow in a particular space, and maybe getting price compression, for example, on some of the SMS layers over here, or different dynamics. I think board members who have a realistic view of where the business is, being bait, as Alan described it, is perfectly reasonable and a good time to exit. There may be small companies that are further into the CRM world, right? We talked about customer engagement is really the critical component of this entire piece. Connectivity is just one piece of it. All the omni-channel offerings that one is in has different margins and growth profiles. Just because one is small doesn't mean that one has to exit. There still can be a wonderful trajectory depending on where you are in the stack and what you want to do with your business. So size isn't the only determinant. One has to take a look at who your competition is, where your margins are, how much capital is needed to go ahead and get to that next stage. And when you factor in all the variables, you make a decision about whether it's time to exit or time to grow organically or inorganically. But as I think we've all been talking about, it's a wonderful time regardless of which side you're on. For a buyer or a seller, the good news is that the weather is getting warm and friendly out.
Indeed. Dimitri, go
Yeah,
ahead.
can you guys hear me okay? I think I'm
Yeah.
maybe having a little bit of a problem with the mic, but want to echo what Lawrence and Alan just said. I do think, when you're small, when early on kind of building up a company, you want to stay focused, right? And so you focus on whatever layer you're addressing at the time, or technology stack you're addressing at the time. So Nexmo had executed, Alan, beautifully on omni-channel strategy, right? Getting SMS and voice and video and other sort of pieces of the puzzle kind of figured out at that software layer, right? And then at the connectivity layer, bandwidth had done well, expanding with Voxbone and several others like Cinch had done the same thing. But when you start getting bigger and better, then you become more of a predator, right? So it's sort of, you graduate from a bait to a predator according to that strategic direction. But staying focused is key, clearly early on, and then taking the market by the grab and sort of having that vision of where the customer engagement, customer experience is going, how digital interactions are evolving, and adding all this type of adjacent capabilities in what seems to be a large TAM is what creates this predator mode. And attracts, and this is why this industry is so attractive. It attracts, carriers now looking very strategically at the space. The likes of Verizon, AT&T, and others. Probably this isn't going to go unnoticed. So we'll see if they make any moves down the road. Because we're absolutely graduating into the territory where they're going to get interested in the 5G and the mobile experience we're getting in. It is an attractive market to be playing in. And similarly with the enterprise leaders, the Salesforces, the Oracle, the IBMs, the Facebooks of the world. What are they noticing? What are they going to do as it relates to our industry? Will be interesting to watch as well. So there's going to be a mix, but staying focused at the early stage and then graduating into predator mode.
Yeah. Maybe I can jump into. I mean, I agree with what folks have said, and I guess just make a couple quick points, which is one, Microsoft, Cisco are getting involved in this. These adjacent industries are getting involved. So to think you're going to be a small player and just kind of work your way up and consolidate is pretty hard. Second of all, I think don't, integration costs after an acquisition are hard, and small and medium sized firms usually don't have the expertise and the folks to really merge together with another firm, and especially when two firms are very similar in size. So you're like, okay, I'm kind of a small to medium sized firm. I'm going to merge with this other small to medium sized firm. Those are hard. Those are hard. You got to deal with corporate culture. I mean, we've seen M&A deals fall through over disagreements over furniture and offices. With equal, I'm serious. So most, about half or more of all mergers and acquisition activity are part of multiple ones done by the same firm in the same year. There's these serial acquisitions, and that's the large firms with a lot of cash, have a strategy, and are maybe buying a bunch of technology, or they're consolidating in some way across networks, or as we've been talking about, there's consolidation going in